The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organization mentioned in this podcast.
Hello there, and welcome to Talking Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, what have you been up to of late then?
Hey there, Ian. Great to be back. I've got to say, you find me in a difficult mood. We've got the sort of the half year approaching. And around now, it's sort of time to test the valuation waters. So it comes as no surprise. UK tech PE, it's down to sort of 17.7 times. As you know, Ian, the long-term average is 20. Now, the other side of it, in America, their PE is just under 30. Their long-term average is 27. So in both of our core markets, we've got this divergence. So London, the UK, is down relative to the long term. The US, the home of optimism, is above their long-term average. At the same time, if we look to our respective markets, corporate news in both of them remains broadly positive. We had last night 3 sets of results. I'll leave you to do the heavy lifting on Nvidia. But in terms of the other side of the print last night, we had Salesforce, we had C3.ai, that of course being Tom Siebel's latest gig. And in both of them, very strong results, beat and raise from them, strong messages around the adoption of AI. And that really went into an increasingly skeptical US investor base where they are more worried about the AI bubble, but also all of those, and in fact, this came out of Salesforce anyway, a lot of customers are still in experimentation mode. On the call, Mark Benioff talked about, we closed 8,000 deals and closing Agentforce. That would be the AI offer, which he added on, of which half are paid. And that shows us the amount of sort of tire kicking still in the AI market. Now, at the same time, concerns about the global macro and indeed the US macro weigh heavily across the industry. So the concern for investors is how immune can AI be if there are spending cuts, given that a big chunk of it is still at that experimental stage rather than full deployment. Anyway, those concerns are washed away. Ian, do you have any thoughts on Nvidia, how it went last night?
I wish I did, to be honest, other than...
We're all blown away.
We are a little bit all blown away. You were sort of hoping that something would take the edge off it, but no, it continues to trundle on there. As far as US news that I'm scratching my head at the moment, it's these comments from the US about what Trump is going to do in terms of stopping the likes of Cadence, Synopsis, Siemens EDA from selling their chip design and electronics design software into China. It's an interesting development as to how that may hold back the Chinese guys or maybe stimulate the Chinese to go and create a lot of this stuff for themselves. In some ways, you would like there to be a continuing link between the international semiconductor electronics world of development and technology advancement. Some Cadence Synopsis certainly provide that. But I worry that the ongoing impact of that is possibly more dramatic than people at first realised, because these guys are key to the development of the new applications. It's all very well us talking about AI products, but for consumers of technology products that are anything other than AI, Cadence and Synopsis, and to a lesser extent Siemens EDA, are fundamental to it all.
You're pretty much echoing what Jensen was saying last night on the Nvidia conference call. You'll recall that when the export controls went through, i.e. him selling chips to China, he owned up to losing $8 billion US in revenue for that. Now, the sort of the chip, as you know, the one in the firing line is the H20. He doesn't have a market outside of China for that. So he also takes a hit in terms of his ex-inventory. When I saw that, I went straight to just wondering, what was the impact then really showing us the strength of the underlying end market. His inventory days actually fell through the quarter to just over 41 from 60. So they are flying along through it. Now, the other side is that Jensen and Nvidia, they are talking about reshoring, bringing fab to the US. So that is true. He also heavily praised Donald Trump's vision. But then that was couched with, China is the biggest market for this. And if we're not supplying them, China will or somebody else will. The other side is that Nvidia is coming to Europe next week. We may find some of the sort of the European partners get a bit of an airing as he goes around and talks about what da company is doing. So you may see a little bit of lift in terms of the European names next week as they hitch themselves to that bandwagon.
We'd like to think there might be something positive to come from that, yes. Today, I've been sort of scratching my head as to what's going on with the pensions investment review. I won't say a damp squib, but I don't know, depends really upon your view as to what you were expecting from it. Was this ever going to save the UK equity market? No. Was it going to do something for the UK small and mid-cap market? I think there were a number of people who were in a sort of deluded state that they thought that it might help AIM out. This pensions investment review that's come out this morning, when a document's got more to say about the Universal Studios in Bedford in terms of support and where that could drive the UK economy than it has to say about AIM and Aquis, I think it's time for the UK small and mid-cap space to perhaps look to itself for ways to improve itself rather than hope for the bailout. I don't know what your view is on that.
I thought there would be more positive coming out of it. Now, at the same time, when I did sort of just talk through valuation differences and where we were relative to the long term, cheap on its own doesn't create a buying environment for investors. However, what it does do is create buying opportunities for cheap buyers. And that's typically financial PE type buyers more so than trade. They just pay differently. And what it does then contribute is the ongoing de-equitization in terms of London. And in fact, that's just an AIM thing. It's a feature of the wider market.
Yes, I think it's easy to get overly pessimistic. There are things within this that are going to help address fundamental underlying infrastructure issues in the UK, give a nudge up the backside to a number of areas sort of where local spending has been lower than it should have been. Things like the Oxford-Cambridge corridor, just demonstration that the government is willing to shake things up a little bit. But it also smacks to a certain extent of, we've created this, we're going to get the money from the pensions with a good excuse for taking money from the pensions when perhaps we shouldn't. And that makes it sort of politically expedient and gets the public on side in a way in which I don't think forcing money into the public equity markets was ever going to get the public on side. So I'm encouraged by the fact there is something being done. As a sort of exposure to my public equity markets, it's frustrating that it isn't. But perhaps the good thing is that this is to wake the small cap and mid cap market up to actually, what's it got to do to be a good home to external money? And frankly, when we look at it over the last 10, 15, 20 years, the UK small and mid-cap space hasn't been a good home for capital. UK small and mid-cap space hasn't been doing that, and it's been failing. You can't expect to get decent outperformance by just buying dull stuff and avoiding the risk.
At the same time, that there are push and pull factors at play. So one of the issues, as we were talking about Nvidia earlier, shares haven't done anything this year. Whereas that small group of shares in terms of the Mag 7 was your way to gain outperformance as an investor over, say, the last 18 months. That's not necessarily the case anymore. In addition to that, given geopolicy and policy flip-flopping in the US, don't you believe in the argument that US investors or those who have made money from US stocks, which would be the very largest, may now start to look internationally. And as they do look internationally, the UK has benefits and advantages which it didn't have in the past. Now, I said earlier that just because stocks are cheap in itself won't attract buyers. However, if you add into that stable political background, rule of law, those sorts of things.
Yes.
Is there a case now for more international eyes to look to the UK rather than guys and gals who have been doing it and may have grown a little bit jaundiced just watching, to your point, years of underperformance? Could you now get new buyers?
As analysts who've had the occasional stale buy note, should we say, you've always looked for what's the catalyst. And when we look around, the UK market has lacked that catalyst to say, okay, it's cheap, and there are a number of other cheap markets, but actually perhaps what I have on my desk here in the terms of the Pensions Investment Review, it's not perfect, but it is at least showing that the government has got some mind to do something to try and kick things up a gear, as it were. Evidence of something happening, even though it's flawed, perhaps, is better than no evidence of anything happening. And that's perhaps where we've been for the last 7, 8, 9, 10 years.
There's quite a cohort of people arguing this point as well. So maybe the noise just prompts more action. Bit of a wild card for you, Ian. Have you put any thoughts into PISAs? So just for listeners, PISAs is the stock exchange new trading program for private companies. So the book opens for a few days and then private companies can basically sell shares to whoever. The negative is that if private companies can remain private, yes, have access to a public or public with caveats market, then they need never join AIM or any exchange. The other side of it is that positively, this will get junior companies or smaller startup companies or just thinking more about equity and how to trade their shares. And maybe it would actually be a stepping stone to a full listing. Do you have any views on it, Ian?
I can see the reasoning behind it. Yes, it's worth having, I think the phrase that the LSE like to use at the moment is a continuum, in a way in which that companies can grow and at some point they can sort of get into the habit of having trading, and employees can have the concept of share ownership as part of being an employee. And that's something that, to a certain extent, is missing in the UK and in Europe, especially when we compare it to the US. But is it really fundamentally going to change anything? I don't think so. Is there going to be enough volume through it for anybody to learn anything? I don't think so, because many of these companies that they're trying to attract have been able to achieve this already anyway, because who are the main traders in this? It's going to be the employees or the existing shareholders. And that's been going on for many, many years, that these companies have been able to organize it for themselves. I'm not really that sure what has been added by this. And when you start to open it up to, okay, who else is going to have access to it? Well, then you have this issue about insider information.
I would caveat insider information. Really, it's about a lack of information.
Yes, the lack of information, the lack of its ability to draw sort of known facts and to check facts, I think is the thing that is the problem with PISAs. And it's the same problem as exists to a certain extent across AIM because of the woeful state of research in AIM and small cap. If everybody just says everything's a buy, then what is anybody to judge anything against? If no one puts out any kind of counter argument to anything, you just have an advertising system. You don't actually have a market.
I see a sort of long-term structural shift in terms of AUM owned by the retail community rather than the institutional community. Numbers sort of all over the place on it, but the underlying idea being retail possibly has sort of 26% of UK AUM, and that will be up from 20% back in 2020. But I don't believe that they're allowed to participate in PISAs.
Yes. Who is this game for, and how do you prove that it's really working any better than their existing solution? The issue that the UK market has in terms of involving the retail investor is what's sexy, what is going to get people involved? How do you engage the public? You can engage them with various attractions, be it dividend, be it growth, be it tech, risk. And I don't think there really is that much of actually any kind of marketing plan. And there's no real sort of view as to this is what the market is looking for. There's no real understanding of who is the private investor, and is the private investor retail market that we look at now really the market that we are trying to sell into?
I have a view that the retail investor could actually save AIM. They are smaller companies. The minimum market size is a lot smaller, so it's more fitting in terms of the retail world. The shares there are dominated by lots and lots of small packets of shares. I think that could be where AIM gets another leg. However, the companies on the AIM market have been fed a story by their brokers that don't worry about retail. It's all for institutional. We understand institutional buying patterns. We know who they are, and we can better work trades into them. So just neglect the retail community. But I don't know if that's a valid argument anymore.
I struggle with both sides of those arguments. There is a problem that AIM faces, that AIM has a legacy, should we say, and it has got to get over it. And it has to work out how the market works for the investor and not for the broker and for AIM. And I think it's quite obvious from outside the market that the market doesn't work for the investors or the companies particularly well at the moment. I'm not sure it has for quite some time, really.
It's not just a UK thing. I was reading the Data Tech. So Data Tech based in South Africa, talking about their strategic review in their print this week. Strategic review to address the large discrepancy between share price and the intrinsic value in terms of the underlying business. So it's not just UK. We mustn't beat ourselves up too
It's
much.
a small cap market thing.
Yes.
And I think there are some markets that Sweden is the one that everyone points to, but Sweden to a certain extent has had a relatively clear path to it and has not had the legacy of the USM, shall we say, which something that we forget about with AIM is that AIM's main job initially was not to be the USM and not to be the mess that was. And it hasn't been the mess that the USM was, but it still needs to address the balance of the business model. And I think that's when you talk to the managements of companies is where they struggle with it. And it's all very well people talking about, let's have this reform now. Well, for the broker community and for AIM itself to come on side suddenly say, oh, this is terribly unfair, this is all terrible. Well, you haven't really been standing up for the investors and for the companies over the last few decades. It's all very well sort of talking now when things are at the edge of the cliff, but you got us here, boys and girls. Perhaps someone should be taking some mea culpa.
As you were talking through that, and you're talking about sort of beaten up companies and sectors, there's an alarm going off in my head, and it's called gaming, or specifically video gaming. As you know, that sector has been absolutely through the wars over the last 18 months, 2 years or so, as there was a shift in terms of the buying environment. Not so much demand for games, but absolutely in terms of the buying environment. And then, of course, the industry got sucked into a new cost model in terms of developing the next generation of games. So the market was left with a massive surplus and goes into a tailspin. Last week, we had a company called TrueFin, an AIM company, similarly complaining about their share price and launched a buyback. However, it did flag up that its gaming division is on a bit of a roll. They had launched a new game called Balatro. I had a quick check on Steam, which is sort of the distribution platform. They're getting some seriously good numbers out of there in terms of followers, top sellers, positive reviews for 98%. So life in terms of video gaming. And then, of course, this week, we had a company called Frontier Developments, trading update from them, year end for them, 31st of May, slightly ahead of expectations from a top line, but a big beat from the bottom line. And then sort of the icing on the cake last night, Nvidia to come full circle. Gaming revenue from them was a record 3.8 billion, up 52% year on year. Now, the last time we saw a number like that was in Q1 23, and then it was sort of 3.6 million. Then it collapsed after that. Really interesting to see if that's a sector beaten up. Predominantly the companies who are sitting on AIM is ready for a bit of a turn. Lots of value in there if that is the case.
Yes. And it's not a bad place to be for these companies if they can sit and ponder the downturn, but as long as they can be out the other side and there are fund managers there and perhaps private retail as well. willing to support them over that process. And that's a good thing. I can't really look at that market and say, gosh, I think private equity would be great in that for the tiddlers. No, it wouldn't.
As you said that, I thought, well, surely trade is the best option for that, given trade can throw distribution on the authors, but there's been a complete lack of that as well of late. Yeah.
But if you come to the market and say, look, this is what I need, this is what the scale is, this is what our plan is, why does that not work on AIM? I mean, it has worked.
Absolutely, it has worked. Gaming was a glamour sector and then just crumbled. So hopefully winds of change coming through in that sector. So Ian, we've pretty much concluded reporting cycle here in the UK and sort of the last vestiges of sort of Q1 coming through. In terms of the US guys, still it drags on for a few more weeks. But we're starting to look at valuation. We're at the half year. Clearly, as we went into the year, there was a lot more optimism there, thinking the macro is improved. Those hopes were dashed. And then, of course, we had the Trump play, which then unwound. And then we just had uncertainty is everyone's favorite word. Any thoughts in terms of how H2 plays out?
I think, though we spent the first half of the year talking about the re-rating of UK market and small cap, there's going to be a certain amount of reality striking home where we realise that some of the things that have done very well over the last 6 to 9 months may actually have just had a little bit of a run, and that what was a bad company 9 months ago and 6 months ago is probably still a bad company now.
That is definitely what the US people are saying. And then, of course, their concern is a deteriorating macro in America and how that then unwinds the gainers that we've had this day. And maybe I'd spend too long over the past 12 hours on a whole series of analyst updates from, yay, go for it, US companies and, of course, Nvidia. But the whole is it, isn't it, in terms of the ROI measures on AI may be mixed, but there is still a big surge of enthusiasm for the underlying technology. So hopefully that's the one that pushes us through into H2.
Maybe, just maybe.
On that bombshell, Ian, thank you very, very much for your time.
Thank you too.
Brought to you by Progressive Equity.